They shouldn't be really alarmed because to some degree it's a buyer's boycott. Not until a few minutes ago did we get up to 500 million shares. Now you're going to see a Dow down 800. You would expect you'd see somewhat of a stampede. You haven't. I would like to throw in one other factor, not because it's a key factor, but because I haven't heard it mentioned all day, and that is the renewal of Brexit fears. The Parliament voted the May government in contempt of Parliament. That hasn't happened since Anne Boleyn could wear a baseball cap. So this is something brand new in history, and that means that that government is probably under threat. So you can add Brexit to inverted yield curves and slowing down in trade. And the other thing is, while we're waiting to find out what, if anything, happened in China, as one of the earlier guests alluded, we don't have a deal yet with Europe. So there's a lot of open-ended items out there, and that's what got the market so concerned.
And I think also that news out of the UK was right around the time that the downside accelerated around midday, I suppose.
Absolutely. So. Right after that, we broke below the 200-day moving average, and that was all she wrote.
So that's something certainly good to highlight there. Rick, you've been at this a long time. I would venture to say maybe this is the most widely watched vigil for a flattening yield curve maybe we've had in any cycle. What are we supposed to draw from the setup right now in the yield curve, and what are we not supposed to conclude?
Well, it is by far the most scrutinized yield curve in history, the small inversion, with 5 years being somewhat out of whack. But the point here is that after everything central banks have done to quarantine all the securities around the globe, to manage interest rates at a level that would be lower than otherwise, it has a price to pay. And I think we're seeing a little bit of that with the yield curve, but that doesn't change the dynamic of investors. See, it's all about perception. We've talked about this for months and months because we've expected it was coming, especially when you consider there's a rate increase still coming in December and probably several more next year. It's how investors behave. And ultimately, this is going to be a messaging issue for the Federal Reserve. If they've impacted interest rates 50, 75, 80 basis points, that makes a big difference, not necessarily in the 5 years specifically. It's always been a darling on the curve. There's one other thing I'd like to bring up, Mike, and that is there's a lot of risk parity trades again today, especially with the holiday. Well, it's not a holiday, but morning and HW proceedings tomorrow. That has added to the volatility. But right around 2763, just around that 200-day moving average in the S&Ps, 32 billion SPUs, S&Ps were sold into the marketplace on some of these programmed black box setups, and they also at the same time were coming in buying some treasuries. So there's a lot of channels going on, especially on the long end. Under 325, the 30-year accelerated. And by the way, the 200-day moving average in 5s is 280, in 10s it's 296, and in 30s it's a bit below the market at 313. The reason I mention it is, unlike many other markets, the 200-day moving average in the fixed income space is usually associated with higher rates, looking for rates to hold and bounce off of that level.
Charlie, when you look at financials right now, the XLF down 4%. Given the comments that we just heard from Wilfred Frost and from the CEOs at that banking conference, that financial conference right now, are these a buy? Do you stay away from them?
Yeah, you know what I'm going to say. It's going to be individual names by names.
Yep.
In general, the regional banks are still not cheap. They got too expensive at 2 times book. There's some banks that are very cheap. We've now got Goldman Sachs trading at less than book value. One of the best indicators of value in investment banking is an investment bank trading for less than book. So I would say Goldman Sachs, our favorite, Lazard. There are a number of banks that are now very cheap, but the regional banks are not.